the letter arrives in your mailbox. Return address, Internal Revenue Service. Your stomach drops. But here's the truth. Most IRS audits are nothing more than a letter asking you to verify item on your return. Today, I'm going to demystify the audit process, show you what actually triggers one, and most importantly, tell you exactly how to make sure you're never caught unprepared. Welcome back to taxmerica.co. I'm Sharon and I'm going to help individuals, freelancers and business owners navigate the US tax system confidentially. Today's video covers how IRS audits actually work, the actual audit rate, it's lower than you think, the real red flags that trigger audits, how to respond if you get one, and audit proofing strategies to protect yourself before it ever happens. The audit rate reality. Let's start with good news. The IRS audits less than 0.4 of all individual returns. That's less than 4 in every 1,000 returns. Your odds of being audited are actually lower today than at any point in the past 40 years, largely because IRS staffing had been reduced over time. However, the 0.4% is an average. Certain types of returns and income levels face dramatically higher rates. Returns with Schedule C income, high cash-intensive businesses and very high earners face audit rates of 2 to 8% or higher. The IRS allocates resources where it sees the most potential recovery. Types of audit. Correspondence audit, most common. This is a letter in the mail asking you to verify one specific item, maybe a deduction, a dependent, or income you reported. Most taxpayers can respond by mail with documentation. It's not as scary as it sounds. About 75% of all audits are this type. Office audit. You're asked to come to an IRS office to discuss your return in person. Bring documentation for the specific items they request. Nothing more, nothing less. Field audit, most serious. An IRS agent comes to your home or business. This is rare and usually reserved for complex returns or businesses. This is when having professional representation is absolutely essential. The DIF score. The IRS uses a computer scoring system called the Discriminant Information Function or DIF to flag returns for audit. Every return gets a score based on how much its numbers compare to statistical norms for similar returns. The higher your DIF score, the more your return stands out from others in your income bracket. This is why extremely unusually, deductions relative to your income are risky. They spike your score. Now, for the section you came for. These are the actual items that increase your audit risk. Some of these you can control, others are just facts of your financial life. Knowing them helps you to be prepared. Red flags for all taxpayers. Large charitable deductions relative to income. Donating 20 to 30% or more of your income to charity statistically flags the return. The IRS knows what's typical. If you do donate generously, make sure you have impeccable documentation, written acknowledgements, bank records, and for non-cash donations, qualified appraisals for items over $5,000, math errors and inconsistencies. The IRS computer catch math errors automatically. They also cross-reference 1099s and W2s with what you report. A mismatch, even accidental, triggers a review. Claiming a home office deduction. This is a legislative deduction but historically a high audit trigger because it was abused for decades. The key is the space must be exclusively and regularly used for business. Having clear documentation of square footage and exclusive use is critical. Refundable credits, especially EITC. The Earned Income Tax Credit has a historically high error rate. So, the IRS scrutinizes these claims heavily. Make sure your income, filing status and dependent information are accurate. Red flags for freelancers and self-employed. Claiming 100% business use of a vehicle. The IRS is deeply skeptical of 100% business vehicle use claims because almost no one truly uses a vehicle 0% personally. Even 95% business use is more defensible than 100%. Keep a detailed mileage log. Losses year after year. Reporting business losses for 3 or more consecutive years signals the IRS may consider your activity a hobby rather than a business. Hobby losses are not deductible. The IRS looks at whether you have a profit motive based on factors like how you run the business, your expertise, and time invested. High expense ratios. If your expenses are 90% of your revenue consistently, that's unusual and may raise questions, especially if those expenses are in categories like meals, travel, and entertainment. Document. Large cash businesses. Restaurants, car washes, salons. Businesses with lots of cash transactions face high scrutiny because income is harder to verify. Keeping precise records is non-negotiable. Red flags or high earners. The IRS audit rate jumps significantly at higher income levels. For returns showing income over $1 million, the audit rate is about 2.5%. More than 6 times the average. High earners often have complex returns with multiple income streams. Investment income, partnership interest, and international transactions, all of which the IRS examines closely. Foreign bank accounts. If you have a financial interest in or signature authority over foreign accounts totaling over $10,000, you must file FBAR, FinCEN Report 114. Failure to do so carries massive civil and criminal penalties. Offshore income. The IRS has pursued offshore tax evasion aggressively for over a decade. All foreign income is taxable to US citizens and residents regardless of where they live. Large partnership losses. K1 losses that significantly reduce taxable income on high income returns draw IRS attention. Red flags for business owners. Payroll tax issues. Late deposits, unpaid trust fund taxes, or discrepancies between payroll records and tax filings. Misclassifying employees as contractors. If workers are truly employees, but you pay them as independent contractors, you avoid payroll taxes, which the IRS actively pursues. Personal expenses deducted as business expenses. Lavish meals for family claimed as business entertainment. Personal vacations claimed as business travel. Home improvements claimed as office upgrades. These are audit red flags and potential fraud territory. The best audit defense is contemporaneous documentation. Records made at the time of the expense, not reconstructed months later. Apps like Expensify or Receipts by Wave let you photograph receipts in real time. The documentation rule. For every deduction you claim, you should have documentation that answers what was purchased, when, for what business purpose, who was involved, for meals and entertainment. The IRS specifically requires the business purpose and names of attendees. A credit card statement alone is not sufficient documentation for business meals. Records retention. How long should you keep tax records? Generally, keep records supporting your return for at least 3 years. That's the standard IRS audit window. However, if you underreport income by more than 25%, the window extends to 6 years. If fraud is alleged, there's no time limit. My recommendation: keep everything for 7 years digitally. Cloud storage makes this easy and essentially free. Working with a professional. One of the biggest advantages of working with a licensed tax professional is audit representation. If you're ever audited and we prepared your return, we handle all communications with the IRS on your behalf. You don't have to talk to them. We know what they are looking for and what to provide, and importantly, what not to volunteer. Having professional representation in an audit can mean the difference between a routine process and a nightmare. At taxmerica.co, every tax return we prepare comes with a commitment to stand behind our work. If the IRS contacts you about a return we prepared, we are in your corner. Viewer questions. I'm going to answer a few viewer questions. If I'm audited, does that mean the IRS thinks I'm cheated? Not necessarily. Many audits are random. Others are triggered by statistical anomalies. Your return looks different from the norm, but it's fraudulent. The IRS distinguishes between errors, negligence, and fraud. Errors typically result in additional tax plus interest. Fraud carries civil penalties of 75% and potential criminal prosecution. But this is reserved for deliberate, intentional evasion. Can I represent myself in an audit? Technically, yes, but I strongly advise against it for anything beyond a simple correspondence audit asking for one piece of documentation. The IRS agent is a professional. You deserve professional representation. What happens if the IRS says I owe more than I can pay? You have options: installment agreements, offer in compromise, penalty abatement, and in rare cases, currently not collectible status. Do not ignore IRS notices. That only makes the situation worse and more expensive. Key takeaways. Overall, audit rates are low, but certain return types face much higher risk. Most audits are simple correspondence audits resolved by mail. The biggest red flags: unusual expense ratios, large deductions relative to income, recurring losses, and mismatches with the IRS records. Audit proof your self-worth, meticulous documentation, good record keeping, and professional preparation. If you receive an audit notice, don't panic. Get professional representation immediately. The best way to handle an audit is to be well so prepared, and that holds no fear for you. We prepare every return with audit defense in mind, and we stand behind every return we file. If you want that peace of mind, book your free consultation at taxmerico.co. And if this video helped you, please share it with someone who needs to hear this before tax season. Like, subscribe, and I'll see you in the next one. If you found this video helpful, like this video and subscribe for weekly tax tips. Drop your questions in the comments below. We read every single one. Book a free 15-minute tax consultation at taxmerico.co. Let our experts handle your taxes stress-free. Thank you.